Welcome to vTalkInsight, Risk Sentiment Daily for February 6, 2026. Markets have shifted from a neat rotation story to a much broader de-risking as tech, crypto, and even traditional safe havens come under pressure, while few structural supports still hold up the medium-term picture. Across assets, today looks and feels like a broad risk-off session rather than just another rotation day. Equities are under pressure with a wide sell-off in both the S&P 500 and the Nasdaq 100, and volatility has jumped, with the VIX pushing into the low 20s. That combination of a 1.23% decline in the S&P and a marked volatility spike signals that investors are actively de-risking rather than simply rebalancing. Under the surface, market breadth is notably poor. Only about 18% of S&P constituents have outperformed the index over the past year, while many stocks have suffered deep drawdowns despite relatively modest index-level moves, a pattern that looks like an internal bear market. Technology and materials are leading losses, and the Nasdaq 100 is experiencing its sharpest two-day decline since August, underscoring how dominant segments of the prior rally are now driving downside. Compared with earlier this week, when stress was more localized in metals and software and offset by rotation into value and non-US assets, today's weakness is broader and reinforced by cross-asset deleveraging and softer macro data. Yet this is not wholesale capitulation. Credit markets remain orderly, AI infrastructure demand is still absorbing capacity, and European banks and emerging market debt continue to see solid interest. The net result is a clearly risk-off tone at the index and cross-asset level, tempered by a few resilient pillars that could matter once the current de-risking wave exhausts. The most visible driver of today's risk-off tone is the AI software correction and tech de-risking. A broad-based tech sell-off is intensifying, with $1 trillion of software market value erased in a week and the Nasdaq 100 posting its steepest two-day slide since last summer. Pressure spans mega-cap platforms and high-multiple software names as investors reassess how sustainable AI-driven business models really are. Market psychology around big tech spending has flipped. CapEx plans from firms like Alphabet and Amazon, once read as confident signals, are now meeting skepticism as investors focus on earnings, free cash flow, and return on capital rather than growth at any price. Questions about who truly owns proprietary data, how AI will affect software margins and recurring revenues, and whether horizontal, more commoditized software can defend its economics are all contributing to valuation pressure. This tech de-risking is not confined to public equities. Private equity portfolios heavy in 2021 and 2022 software buyouts, as well as business development companies with embedded software exposure, are facing heightened scrutiny and notable drawdowns. At the same time, portfolios are rotating toward value, defensives, and sectors like aerospace, defense, utilities, and staples, signaling a more defensive equity stance and raising the hurdle for any renewed index-level upside that would still rely heavily on big tech leadership. A second major bearish force is cross-asset deleveraging and crypto stress. Recent days have seen sharp, correlated declines in gold, silver, Bitcoin, and high-momentum software stocks as higher margin requirements and forced unwinds hit speculative positions. Bitcoin has broken below $64,000 with accelerating downside momentum, while a broad momentum unwind has pulled both Bitcoin and oil lower, pointing to de-risking that extends beyond any single asset class. Within digital assets, the adjustment is particularly acute. U.S.-listed Bitcoin funds have seen sizable outflows, and Bitcoin has shed more than $1 trillion in market value since its October peak, fueling a crisis of confidence in its supposed store of value role. At the same time, discounts to net asset value at some crypto treasury companies and expectations of consolidation or closures highlight how investors are demanding cleaner structures and are less willing to tolerate idiosyncratic risks. Precious metals are adding to the sense of instability. Silver prices have plunged more than 11%, with volatility near record highs, and gold has reversed recent gains despite earlier outperformance versus Bitcoin. Silver swings are increasingly viewed as a barometer for retail-driven markets, suggesting that if these sell-offs intensify, stress could spill further into other retail-heavy assets, even as some participants look to regulatory progress on crypto market structure as a potential medium-term stabilizer. The third key bearish driver is softening labor data and what it implies for growth. January saw more than 108,000 job cuts announced, the highest for that month since 2009, with layoffs more than doubling year-on-year and hiring plans at their weakest January level since the Great Recession. Job openings have fallen to their lowest level since 2020, and weekly jobless claims have surprised to the upside, all pointing to a labor market that is losing some of its prior resilience. Forward-looking projections now see unemployment rising toward 4.6% by mid-year, with weakness expected to persist through the first half. While these are still forecasts and many of the job cuts are announcements rather than realized layoffs, a sustained shift would mark a turning point for both economic momentum and central bank expectations. If labor data continue to deteriorate, markets may place more weight on slower earnings growth and recession risk, even as some participants anticipate that softer data could ultimately invite a more accommodative policy stance. Outside the U.S., the growth picture is mixed as well. French indicators such as sub-50 purchasing managers indices, very low inflation, and weak consumer confidence signal notable softness, even as some banks report decent revenue growth in that market. Taken together, rising job cuts, weaker hiring intentions, and patchy global data are feeding into today's risk-off tone by undermining confidence in the durability of the expansion. On the bullish side, resilient AI infrastructure and semiconductor demand remain a powerful counterweight to the current risk-off mood. Memory chip demand linked to AI servers is so strong that capacity is effectively booked through 2026, and major AI infrastructure providers report that all new data center capacity is being absorbed immediately by demand. Hyperscaler AI capex is projected to exceed $400 billion by 2026, a five-fold increase in just 3 years, underscoring the scale of this investment cycle. This demand is already showing up in earnings. ARM has just delivered its fourth consecutive record quarter, with data center royalties doubling year-on-year and total royalties up 27%, while Nordic Semiconductor has surprised to the upside and seen its shares jump on renewed confidence in AI-related spending. Even though investors have become far more sensitive to high expectations, as seen in sharp post-earnings reactions for names like AMD, the underlying message is that the picks and shovels of AI still enjoy a strong fundamental backdrop, offering selective opportunities despite broader tech volatility. Another supportive driver is the combination of constructive credit conditions and strong flows into emerging markets. Investor demand for high-quality corporate bonds remains robust, illustrated by Oracle's recent deal that drew orders 5 times larger than the issue size. Despite concerns about private credit exposures, abundant market liquidity and recent regulatory adjustments are expected to limit near-term financing strains for banks, and low interest rate volatility, with little imminent tightening, is creating a favorable backdrop for carry trades and corporate credit more broadly. Emerging market local debt is also drawing meaningful inflows, with roughly a third of last year's total already invested this year, signaling that investors still see value and can differentiate across regions even in a choppy environment. This resilience in credit and EM contrasts with the volatility in equities and crypto, suggesting that the transmission of stress into the core funding markets remains contained for now, though it also means investors will be watching closely for any sign that private credit or sovereign supply pressures start to erode this support. The final bullish pillar is strong European banks and an improving backdrop in parts of Europe. Several European banks are reporting very healthy profitability, with some projecting returns on equity above 20% through 2026, while asset quality remains stable. Recent results from institutions like BNP Paribas and DNB have beaten expectations, with upgraded profitability guidance, solid revenue growth, and a notable rise in fee and commission income that points to more diversified earnings streams. At the macro level, some European indicators are moving in a constructive direction. One major bank highlights that growth, inflation, and interest rates across Europe are converging toward levels that support a positive investment climate, and sees particular strength in its home French market through rising household consumption, even if headline survey data there remains soft. Combined with relatively attractive valuations for European banks and industrials compared with the US, this leaves Europe looking like a relative bright spot within an otherwise risk-off global tape, especially if expected monetary easing from the Bank of England and gradual disinflation in the euro area materialize. To sum up, today's landscape is defined by a broad risk-off tone, driven by an AI-led tech correction, cross-asset deleveraging centered on crypto and metals, and increasingly fragile labor data, even as AI infrastructure demand, resilient credit markets, and strong European banks provide important stabilizers. For multi-asset portfolios, this mix argues for close attention to how far the current de-risking extends, whether stress begins to migrate into funding and private markets, and how quickly policymakers respond to softer growth signals. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.